Hello and welcome. You're watching KYC. Today we're going to speak and break down a very interesting company. Zaggle is what we're going to try and get deeper insights on. Let's talk about why we're looking at this company and what is it that I'd want to know about this company first off. It's a platform company, and therefore both IT as well as platform is largely how the business can be described. I want to understand whether it's a unique business. Are there deep moats in it? Because when you're looking at the way in which the stock price has moved and how it's currently valued, it's valued extremely richly, and therefore is it a unique business and are there deeper moats, or can someone come in and replace this business very, very quickly? And if that were to happen, you could well see that as one of the largest risks. Second is with regard to the growth guidance that they've given. They've given, again, very, very strong growth guidances. They've been able to beat it, at least in FY25. Can they continue to do that? Is there upside, downside risk to that? Third is, what's the likelihood of customers staying with the platform? So one is to try and get new customers. That is going to be one concern. The other one is whether the existing customer base will remain with the platform, what is the contract tenure like, and how sustainable is it for the customer to stay back. Fourth is, can margins expand? They've guided for very strong margin expansion. Can they really expand or not? Fifth is there a concern with regard to receivables? Now, why is this a concern? When we're looking at the cash flow, the cash flow from operations hasn't gone up despite profit before taxes rising extremely sharply. That is not a good sign, because that means there are certain receivables sitting in the cash flow statement, which is creating an issue with regard to cash flow from operations. I want to understand whether there is a concern there. And lastly, what are they looking for when they make acquisitions? What's the end goal, and how do they expect and what exactly are they expecting when they're making acquisitions? Is it going to be margin accretive? Are they looking only for geographic growth? Are they looking for product growth? What is it that they're looking for? So all of this we'll try and understand better. Acquisitions, largely the way in which they're deploying cash. So fresh cash largely getting deployed in acquisitions. That's the sum and substance of it. Let's though talk about the company now. Let's talk and let's zoom in to what the company is actually about. First one, it's a fintech plus a SaaS company, right? And I'll break both these terminologies down a little bit better. So it helps businesses manage expenses. So it provides software as a service to businesses. So it's a B2B, 2C company, but mainly a B2B company. It's a business-to-business company. It's the #1 prepaid card issuer in the country. So once they onboard a company onto their platform, they are then able to provide the customer with better products to help manage the expenses of their employees. And that's probably how they do it. One of the ways is through issuing cards. They serve corporates, SMEs, as well as startups, so they have that entire cohort. They have around 3,300 corporate clients at this point. They have over 30 lakh users of their platform, and they have an in-house digital payment technology. Whether this is replicable or not is one of those risks that I was talking about. They were founded in 2011 in Hyderabad. So this is all about Zaggle. Now let's talk about what exactly it does. So it offers prepaid gift credit cards for the employees of their customers. They provide a software for expense tracking for their customers, and it allows customers to provide employee rewards with better ease, automate bill payments, and just manage expenses in a better fashion. They have 4 key products. I mean, they have plenty more, but the Propel Save, the Zoyer, and the EMS are the largest products at this point, with Zoyer growing the fastest in terms of product. Now, I'm going to try and also give you a description of what each of these products do. So Zoyer is the accounting software. So all your vendor payments are routed through Zoyer. That's one of their prime products at this point. They also have Zaggle Propel, Zaggle Save, Zaggle International Payments, Zaggle Fleet Management, and Zaggle Zatix. All of these perform different functions with regard to expenses. One is for reimbursement for employees. One is to help employees make sales. One is for analyzing business expenditure. One is for fleet management, and one is for international payments. So you've got all of these different products which they work with. They have currently over 5 crore cards issued as part of their product stack. And in terms of how it operates, it sells to businesses mainly and not to individuals. It uses automation. There's a current software platform which it sells. It partners with banks, travel firms. It cross-sells multiple products once a customer is onboarded. It helps monitor spending. It's sector agnostic. It has around 400 odd employees in India, and it listed in 2023. So it's a publicly listed company since just about 2023. So 2 years there. Now, in terms of how it helps the customer, it saves business time, money, it reduces errors, it improves cash flow, it offers tax-saving employee benefits. The customer churn is extremely low. It's less than 1.5%. It's a unique business in the fintech space. Can it be replicated is really the question. They do make acquisitions on and off, and currently sits at a market cap of around 4,900 odd crore. So that's how it kind of all stacks up. Currently, trailing 12 months, 1165 crore is the top line of the company. So this is all about Zaggle. Let's now dive deeper into the metrics that we always talk about. And I'll start off first with some of the user metrics and customers that Zaggle has worked with, and how that has grown. If we can quickly pull that up. That's how the total number of users has gone up by. So from just about 9 lakhs, it's gone up to around 31 odd lakhs over the last 4.5 odd years. The total customers also have gone up from 1,092 to around 3,337 in the last 4 years. So you're seeing that kind of inch up with regard to performance metrics and customers, which helps the company grow. We will have Avinash Godkhindi, who's the MD and CEO, shortly to talk to us about how he sees risks play out and what's the guidance like going forward, thereby giving us some bit of color on what to expect and how to value this one. Let's look at the metrics now. Let's talk about the income statement. The growth has been strong with regard to this company. Of course, it's a software company, smaller base as well. So it's grown at nearly a 48% 3-year CAGR in terms of how the income statement has grown. Look at it double in terms of revenue just in the last 2 years. EBITDA also has been phenomenally sharp in terms of its uptick. You've seen EBITDA go up by nearly 37% 3 years. It's fallen a bit in FY23, but we've seen a bounce back in FY24 in terms of EBITDA. Your EBITDA margins, which are traditionally higher, have come off because the company is investing in new and newer features within their platform. And now they are expecting a steady inch up in terms of EBITDA margin going forward. But at this point, margins are a shade below 10%. Profitability has been extremely strong. It's up at roughly a 47% CAGR over the last 3 odd years. So it's a thumbs up across the board in that sense. Let's look at the 9-month numbers as well, and we'll get better context here rather than the last 3 years. Just look at the way in which some of those numbers have gone up by. You've seen revenue go up 77% YOY. EBITDA is up 81%. EBITDA margin is up 20 bips or thereabouts, and profit is up 56% YOY on the 9-month period in terms of FY25. Let's switch over, and clear thumbs up with regard to some of these numbers. Let's switch over to the balance sheet. It's a low debt company, just about 60 crore rupees of debt. And as I did mention, nearly 5,000 crore in terms of market cap. So I won't talk much about debt, but look at shareholders' equity. Shareholders' equity has gone up over the last maybe couple of years because there have been a couple of fresh issues that they've done. The reserves number has also inched up. And the cash, and that may not reflect because there has been a recent fundraise that Zaggle has done. But you look at the cash and bank balance, it sits pretty at 200 odd crore. So you're sitting at a decent level of cash balances. So we'll give this one a thumbs up as well. They're going to deploy cash in new acquisitions, and we'll talk a little bit about that as well. Currently, no risk, at least on the balance sheet. They're doing some bit of equity dilution, yes, but nothing major expected in terms of equity dilution going forward. Let's look at cash flow. And this is where some concern creeps in. While the negative 35 crore cash flow has come down to negative 1 crore, but you've seen, and one of the reasons why there could be a concern here is the receivables have gone up sharply when you're looking at it over the last 2 to 3 years. So the receivables number, because of the sharp inch up, you are starting to see some bit of pressure on cash flow from operations. Can that go away is the question. Can receivables flatten out over the next 2 to 3 years while maintaining that PBT, very strong PBT growth for the company that we've seen over the last 2 to 3 years? And if that were to happen, this will even out. Cash flow from operations will show a solid positive number. Net cash flow, though, still positive because borrowing, which was made in FY24, and equity raise, which has been made in FY25, currently taking care of the net cash flow number. Let's talk about return ratios. Now, again, it's fascinating. The return ratios are on a tapering trend because of the new investments that they've made. This is as per Bloomberg numbers, mind you. The return ratios have come off and therefore something to look out for. A thumbs down. We'll have to wait and watch for those return ratios to bounce back up. Let's talk about shareholding pattern very, very quickly. Now, in terms of the way in which the shareholding pattern has gone, you've seen promoter buying, which is happening here, which is the one key positive, right? You want a company where promoters are interested and wish to buy. Of course, there's been some bit of equity dilution, but promoter buying is the one thing which is positive. In fact, commentary also seems to suggest that promoters will keep increasing their stake in the company, which shows some bit of confidence that the promoters have in the business, and therefore a clear thumbs up. Let's look at the street cred now. The last 6 months or so have been difficult for the company, but the last 1 year returns have still been positive at 26 odd %. So decentish in terms of their 1 year returns. We'll give this a thumbs up. We'll give them that benefit of doubt because the near term has been tough, especially for small and mid cap companies. And this one is within that basket of small cap companies and even in fact one of the smaller ones even within that basket. Now, in terms of outlook, what can we expect? And that's the other metric we're looking at. They're expecting a 63% growth in FY25. Around a 45 to 50% growth is what they had guided for. They've overachieved on that count likely. They've done 77% for 9 months FY25. Mind you, we looked at that number. And therefore, it's a positive with regard to if they are able to continue to grow at this clip. If we look at the way in which customer count has increased, if we look at the way in which all their metrics are lining up in that sense, and how many new customers they continue to onboard, we get regular updates on the exchanges that they have been adding customers on a regular basis as well, and that kind of keeps that confidence that you could see this kind of growth being clocked. Expect margins to go to mid-teens in the next 3 to 4 years. That's at least the outlook that they've given. They're looking at acquisitions, so they're deploying fresh cash into acquisitions. They will use the spare money to buy more companies and to try and grow their market. Now, that's all of that is positive because you would want a fast-growing company to continue to reinvest the money at a higher return ratio. So we'll also have to look at that, whether that return ratio can come back up, can bounce back up. Now, in terms of valuations, and let's break this down. Again, slightly more nuanced. and we've, of course, followed the kind of guidance and outlook that management has given to try and arrive at a valuation. The current market cap is roughly 4,800 crore odd. Your FY25 revenue is expected at roughly 1,250 odd crore. The FY26 revenue at a 50% growth clip is expected around 1,900 crore, and the FY27 top line is expected around 2,800 crore. We've not gone beyond that. It's likely that growth may taper because the base gets higher. We'll quiz the management as to what gives them the comfort, if at all any, that growth may actually stay elevated even at those levels. But let's take FY27 as the base year. Now, they've guided that in the next 3 to 4 years, margins will go to mid-teens, so say 15% by FY28 or FY29. So let's assume a 12% margin in FY27 because that will be a journey which they'll take. EBITDA will roughly be at 340 crore. That means that the stock, which is at 4,800 crore in terms of market cap, will be trading at 14 times EBITDA at that point of time. Also, that will mean, let's factor in maybe 20 to 30 crore of interest payments and depreciation, which has largely been the case over the last few years. And therefore, your profit before tax will roughly, and of course, you'll have to add other income as well. So your profit before tax, we've assumed at 320 crore, and profit after tax is around 240 crore. So it's trading at a price to earnings multiple FY27 of 20 times. Currently trades at 65 times trailing 12 months. So be careful of that. What the risk could be? Execution, growth, and margins. Those are some big factors that we've assumed in as part of our assumptions, and therefore those could have downside risks. And of course, we'll try and get perspective as to whether those risks will translate or not. And we'll speak straight to the management in just a minute. But first off, on the ratings, how does it stack up? Let's pull up the ratings very, very quickly. You have the income statement, balance sheet, thumbs up, very strong growth, cash flow, more to be seen, return ratios, a thumbs down because it's just sub 13% as of now, but you could well see an inch up there as well. With regard to shareholding, street cred, outlook, and valuations, no negatives there at all. So 5.5 is what Zaggle gets on our KYC ratings at this point. Let's quickly look and speak with Avinash Godkhindi, who's joining us, co-promoter, managing director, and CEO at Zaggle Prepaid Ocean Services. Welcome, Avinash. Good speaking with you.
Good morning.
Good morning. I want to first understand from you what really helps Zaggle stand out in terms of competition. Do you believe that the services that you offer are easily replicable?
Great question, Harsh. It's the reality of these businesses is that there is no one thing that stands out. There's always a combination of factors. And we've also had a lot of luck along the way. So I have to be honest that, if we were to try and set up this business today, it's extremely hard because we have 3 pillars in our business. There's software, there's bank partnerships, as well as corporate relationships. And we believe unless you've all these 3 bases covered, you can't build a profitable spend management business, at least in India. Right? And today, for somebody to come in and try to stitch all these 3 pieces up is incredibly hard because it takes a lot of time and you can't buy your way into bank partnerships or even enterprise contracts. So that's the big moat. The fact that we probably started this business at a little before time, but not too before time, 13 years ago. And at that time, getting the bank partnerships was far easier. Banks were a lot more, it was an innocent phase is how I would call it, of the fintech industry, 2011-12. And we worked with banks and we built our credibility. So today we work with 16 banks, all the major banks in the country are partners with us. HDFC, ICICI, SBI, Axis, Kotak, Yes Bank, IndusInd. All the major banks work with us and a couple of international banks, DBS, HSBC. So today, for somebody to come in and try to replicate across these 3 pillars, we believe is going to be extremely hard.
Understood. And what's the likelihood of your customers staying on your platform? I know I've asked you this question before as well, but give us perspective, because we've broken this down from a know your company perspective.
Yes, so look, our historical churn rates for customers is less than 1.5% per year. So customers don't leave us. And there are many reasons for that. One, we have a high quality solution, and it's incredibly difficult to be able to move away once you have a ERP integration, once you have an HRMS integration. There are customers where we have a CRM integration with their Salesforce, etc. So then, the whole ecosystem is a well-oiled machine. Why would you want to move away? Secondly, we are also a partner who brings tremendous value to them. We reduce fraud and leakage, we increase their compliance, we reduce their human capital that gets deployed in mundane tasks. We leverage AI heavily today. We are continuing to do that so that benefit gets passed on to our customers. And they are able to make sure that their teams are more meaningfully used rather than doing mundane reconciliations or checking, receipts, etc. And that is a big value for corporate customers. And secondly, additionally, we are very competitively priced. So that also works in our favor.
Okay, point taken. Now, one thing, Avinash, that stood out for me was your cash flow from operations. It's not going up in the same clip as your profit before tax, which is growing at a very healthy clip. Why do you reckon that's so, and what is it going to take for you to start your cash flow from operations to start turning very solid?
Good question, Harsh. And this is something that we are constantly working on. This is something that's a focus area for us. And we are seeing improvement. You'll see improvement in the full year numbers as well. We track it as a percentage of our revenue. And the reality is the way most businesses operate, you first grow your revenues, then you grow your EBITDA, and then that translates into cash flow. We aren't too different, and there is a slight lag there. There's also a fact that we work with large banks and large enterprise customers, and while we work with them to streamline their payout periods, there is certain lag there, and these are receivables largely from partner banks. Some of the biggest banks in the country, like SBI Cards and others. ICICI. So we are working with our partner banks, we are working with our corporates, and I don't need to say much. You can see the improvement from last year to H1, and now the full year for this year. You'll see numbers improve.
Okay, and what are the factors which are weighing it down currently? Is it receivables, and why is that a bit of a tepid number?
Harsh, as we raised capital in September 2023, right? We've always historically been cash flow positive. As a largely bootstrap company, you don't have a choice. Otherwise, you don't survive. So the DNA of the business and the organization is to be very cash focused, and we continue to retain that. When we raised the capital, the whole idea was to raise that capital and deploy it to grow and to grow fast. And we've been doing that quite successfully, in my view. In that period, it was bound to be that there would be a certain amount of cash that would get deployed, and that would generate the profits, and eventually, the cash comes back to the business. So that was always the plan, and that's how we've been operating, and we're seeing the whole trajectory move as more or less as we had envisaged.
Okay, point taken. What should we look at in terms of growth? Because you've guided for a 45 to 50% growth clip for at least the next 2 to 3 years. Can we extrapolate that and push it forward by maybe a year or two? And the reason why I ask you is because you've guided for margins to reach mid-teens, 15, 16% in the next 3 to 4 years maybe. And therefore, will be valuable from a viewer perspective as to what the upside or downside risk is to the kind of growth, top line growth guidance that you're guiding for.
So Harsh, we've said that we're aiming in the next 5 to 7 years to reach a $1 billion revenue. That's our goal, assuming that the dollar rupee ratio stays in a reasonable range, right? But that's what the target is, and we are on track to do that. In fact, if you see last year, we had started off the year giving a guidance in the range of 45 to 55% growth. We've consistently upped that, and we had given a guidance last of 58 to 63% growth. Happy to share that we've looks like we've crossed that 63% mark as well by a bit. So growth has been very strong, simply because market leadership helps you attract a lot more business, a lot more contracts, a lot more traction. And being listed helps because there's a certain amount of credibility that comes to you as a listed entity. And that brings a lot of comfort to our customers and partner banks.
Okay. All right, Avinash. Would love to have quizzed you even with regard to acquisitions, but unfortunately out of time on this one. But thank you so much for joining us, giving us all of that perspective. Great to speak as always, and wishing you all the very best for FY26 and beyond.
Thank you. Thank you so much, Ash.
Right. Right. With that, we're out of time on this edition of KYC. From myself, everyone who puts the show together, thanks so much for watching. Hope this was helpful. Stay tuned to NDTV Profit.